Good morning, Realtor family. Thank you for joining us today to get caught up on the Paycheck Protection Program and the recent foreclosure moratorium imposed by our legislators. As you remember, almost 4 months ago, we had the pleasure of hearing from Linda Navarro, who is the CEO of the Oregon Bankers Association. I believe the webinar was on the day that PPP program launched. So Linda's hair was much curlier, and there was chaos in the baking industry because they weren't even sure how to roll out the PPP program, what the rules were, guidelines. So I look forward to getting an update from you today, Linda, on the PPP program and how far the banks have come. So in addition to having Linda today, and since we only have an hour, I don't want to go in length on their bios. Linda is the president and CEO of the Oregon Bankers Association. She's very experienced, knows everything you've ever wanted to know about banks and then some. Joining Linda today is Julia Beatty. Julia currently serves in the role as President and Chief Lending Officer for People's Bank. She currently serves on the Board of Trustees for the Gordon Elwood Foundation and Mount Ashland Association. I am assuming our members down in the Rogue Valley are very familiar with you, Julia, and People's Bank. So I'm really excited to hear from you all today on what's been happening, as our members are as well. So why don't we get started? And you two, whoever, will throw out questions, and whichever one of you feels more equipped to answer it, please take it away. But Linda, maybe you start and tell us a little bit about what's happening with PPP applications, money remaining. What's happened since you were with us 4 months ago? Linda's muted.
Well, unmute.
There you go. There you go.
First of all, thank you, Jenny, and thank you to all of you for joining the webinar today. It has been a flurry of activity, and since I last spoke to you, the PPP program was set to expire on June 30th in terms of accepting applications. It was extended by Congress, so it is still open for applications until August 8th. There are still some lenders in the Oregon marketplace, I think Julia's Bank is one, that are continuing to accept PPP applications from their community, but the interest in the program has trickled substantially since the early days of the program. At this point, about 62,000 Oregon businesses have received help from the PPP program. The vast majority of those loans have been under 150,000 in size. So despite some of the media attention on the largest recipients of PPP loans, the bulk of recipients are very much in the small business category, and in many cases, including with some realtors, it is independent contractors and sole proprietors. The dollars that's injected into the state of Oregon are substantial. And while there's a lot of consternation about what the forgiveness process will be and looks like, and Julia is going to be able to speak more to that, I think we need to bear in mind that the unprecedented amount of money and assistance that this program provided immediately to businesses has been very good for our economy at a time that's very disruptive, this pandemic. Nationally, there's still money available. As I said, loan applications may still come in, but there hasn't been much change in about $130 billion that remains available in this program since May. Or early June. It's really been very, very small loans that are being processed in this latest period, and it hasn't moved that needle much. So we do believe that this program will likely expire on August 8th without expenditure of those funds, at least for PPP round 2. There may be another version of a loan program that is established for businesses that are considered underserved in American communities, whether that's businesses owned by minorities or whether that's businesses that are in low-income areas. we may see some proposals around that. But at this point in time, Oregon got what I would consider our fair share. We're right in line with our population, our number of businesses. We're right in line in terms of how much we got. That's different than the early days of the program, where you saw some media suggesting Oregon was behind in receiving its fair share of PPP funds.
So why do you think the interest has, well, two questions. Why, and whether you or Julia take it away, why do you think the interest has waned? And are you saying that any leftover money by August 3rd or August 8th will be reallocated into a different loan program for businesses that you just referenced?
Well, I'll defer to Julia on the first question, because I'd like Julia to hear what her response is. I have my thoughts, but on the second question, I'll just answer that quickly and say, if Congress chooses, then it will be reallocated. I don't think, there's nothing I can announce today that's been reallocated.
But that's the talk on the street, so to speak.
Mm-hmm.
Yeah. Got it. Julia.
Oh, well, first of all, I would like to say thank you for giving me the opportunity to participate in your webinar today. So, Linda, what an excellent overview of the PPP program. She really did hit all of the very pertinent facts, both the development of the program to date and where we are to date. To speak specifically to the question that you posed, Jenny, which is why have the number of applications declined so dramatically? I think there might be a couple of answers, but I think the primary answer is this. I think to a great extent, demand has been met. I say that because, as an example, People's Bank in Medford, Oregon, and the other communities that we serve, which are our surrounding communities, as well as Grants Pass and Klamath Falls, we have done just shy of 1,000 PPP loans. We have marketed pretty aggressively to the community that we are still taking applications. Most recently, in fact, what we did was, because volume had decreased enough and gave us some breathing room, so to speak, we took a little bit extra effort and we actually put out ads specifically targeted to the Hispanic community. That was a community that we felt might have been disinclined to apply just because potentially of a language barrier. So I think to a great extent, demand has been met. To a great extent. I also believe, however, that there is a degree of concern out there that regardless of how much the forgiveness component of the program has been spoken to, I believe there is still those potential applicants out there who are concerned about, will my loan really be forgiven?
Yeah.
And I think that's probably the second driver. So I can talk a little bit more about that when we're ready to transition into the forgiveness aspect of the program. But for now, specific to your question.
Yeah, well, based on your comments, I think forgiveness is going to be the big component of this particular discussion, and what that means, and what do in particular our members, and of course many of our members own brokerages and do have employees, will forgiveness look different for them in an employee situation versus an independent contractor situation? So why don't you go ahead and talk, if you both are ready, talk about the forgiveness component and what our members are going to have to do to get 100% forgiveness, and is that possible?
Okay. Linda, do you want me to run with that?
Please do, Julia.
Okay. You know, it's real interesting. Just like when this program was launched, it was, and I'm going to use a quote that Linda referred to, it was like building an airplane while they were flying it. They were creating the program after it was launched. To a great extent, the forgiveness has been the same. In mid-May, they introduced the first version of the forgiveness application form. And the feedback was, oh my gosh, this thing is horrendous. Very onerous, very long, complicated. The verbiage was difficult to track. You know, I'm sure everyone has heard the phrase covered period. Covered period is used in 3 or 4 different contexts that can be very confusing to the applicant. So that was mid-May. In mid-June, June 16th, they came out with a revised version. And with that revised version, they came out with what they called the Forgiveness Easy Form. And the Easy Form would probably apply to the vast majority of applicants. One of those, for example, is any sole proprietor, independent contractor, etc., who had no employees, they were strictly themselves, during their covered period prior to the receipt and then subsequent to the receipt of their PPP funds. That is one category. So that right there captures quite a few recipients of PPP funds. There are two other components of qualifying companies that would qualify to use the Easy Form. And I'm here to tell you it would cover the vast majority of businesses out there. Now, here's the real hopeful anticipation, and that is this. There has been legislation presented or a bill presented for consideration that a de minimis, a threshold of 150,000 be established, whereby any recipient who received a PPP loan of 150,000 or less could apply for forgiveness simply with a one-page attestation that they used the funds as per intended. They essentially, what's the word I'm looking for? They commit to that. That's not the right word, but they attest to that. And if that were the case, then that will cover nationwide. They say it would cover about 85% of all loans. Ironically, I did an analysis of our approximate 1,000 loans, and it's 86%. So we have been all along hoping that something like this would be developed, because to the point that Linda made earlier, there's quite a bit of funds left in the pool. Part of the reason that there are quite a few funds is also because the loan size has decreased significantly as of late. A real good illustration of that is, I think all of you are aware that there was a phase 1 period of this program and then a phase 2 period. In phase 1, we did right about 475 loans. I'm rounding a little bit. And the average loan size was about 153,000. So even then, just slightly above that threshold. But our average loan size in phase 2, and we've done, well, like I said, almost 1,000, so about 520 loans. Our average loan size is only 42,000. So that just shows you, it speaks to 2 points. It speaks to the point that the number of businesses, they weren't all big businesses. There were a lot of very small businesses that have been aided by this program. But it also helps to illustrate why the funds have not depleted as quickly as maybe others had thought they would.
So did you say that the easy application is approved and in use for are we still waiting for the final word on 150,000 or less on whether they can use the easy form to apply for forgiveness?
The easy form is in use. It is available, and recipients can actually apply for forgiveness with that form. However, it is still somewhat onerous in and of itself. It truly is.
That's false. It's not easy at all.
Well, it's easier than the first one. Everything's relative. So, but it will still require quite a bit of work, I think, personally, in terms of presenting the data, because you have to present your payroll information, number of employees. You have to prove your payroll information. You have to prove that you have that number of employees. You have to be able to prove that portion of funds that you used in outside of payroll. Which, if you don't mind, Jenny, could I go back? You had also alluded in your question about, is it possible to truly get 100% forgiveness?
Yes.
Okay. So when the program was first designed, there was an 8-week period during which recipients had to spend the money. Mm-hmm. And also they had to spend the money, 75% had to be spent on payroll related costs. Well, that's been expanded pretty generously. Number one, the 8-week period for which to spend the loan proceeds was expanded to 24 weeks. And number two, that portion required to be spent on payroll was reduced from 75% to 60%. So a lot of leniency added to the spending of the proceeds that would still allow for forgiveness. So I believe that going back to how the loan amount is calculated, 2.5 times payroll, monthly payroll. Mm-hmm. Well, if that's how you calculated it, and now you have 24 weeks, seems that it would be safe to assume most businesses would spend that at least 60% on payroll in a 24-week period. And
so
then,
oh, I'm sorry. Are you saying then, because I heard from someone that their bank told them, because you know the borrowers are dealing directly with their banks, they had the money they received, the bank transferred it directly to the payroll company. So there's no question that the money was used on payroll for the borrower, for their employees. But they were just told that they're going to have not 100% will be forgiven, that there's a certain portion of the taxes that will not be forgiven that they're going to have to pay back. Is that correct?
Yeah, and I think what they're referring to there is that portion of taxes that is paid by the employee. That is not included in payroll costs. The portion of payroll taxes paid by the employer is considered payroll costs. So only that portion that is employee payroll tax. So I'm not sure how they accounted for that trade.
So perhaps it's misunderstood because they're not paying on that anyway, because it's coming out of the employee's paycheck. So, okay, that makes sense. So really it is 100% of the borrower cost. What happens to the employee in their own taxes is completely separate.
Correct.
Okay, got it. So how
Jenny, can I jump in, Jenny, for a minute? Thank you. Obviously Julia is just a great expert, and her bank has been amazing in serving their markets with PPP lending. I wanted to just acknowledge two things. One, the easy form that's in place now, yes, still requires the calculations. The attestation, one-page attestation Julia was referring to, is part of a Senate bill that's still under consideration. That would be tied to the de minimis threshold of $150,000. So we are in an advocacy mode right now to get that passed. That if that was passed relatively soon, then it would simplify even beyond the easy form that process for all those 85% of borrowers that have loans under 150,000. But that is not a done deal in terms of our expectations. We think there's a good chance that it will pass, but it's not passed, and Congress isn't easy to rely on for passage of a bill, especially during an election year. So we're holding out strong hope that that will still pass, but it hasn't yet. And I want to put that out there. Julia, perhaps in her future remarks, can talk about timing, because I know there's a lot of questions about when to apply, and are we waiting for this de minimis threshold before we make an application for forgiveness? Yeah, I'll stop there and turn it back to you.
So there's a couple, let's get to a couple questions. Is the extension from 8 weeks to 24 automatic, or does the borrower actually have to request it from their bank?
It's automatic.
Okay. And another question, does the tax write-off portion vary between businesses with employees versus sole proprietors?
The tax write-off, I'm not quite sure I understand the question.
Yeah, okay. Are you accepting forgiveness applications already from people who've already gotten through the process? So once they get into your hands, what's the verification process? What's your role? I'm assuming the borrower only deals with the bank that lent them the money, and you determine whether it's going to be forgiven, or do you have to go through SBA or somewhere else to get the final word?
That's interesting. During the application process, our role was to make a good faith effort in a reasonable amount of time to ensure that what the applicant provided was true and accurate. That was our role, very clearly defined. Much different than a typical loan application where we determine if we feel like a customer can pay us back. That whole piece was taken off the table. It's quite similar actually in the forgiveness piece. We are asked to use a good faith, make a good faith effort within a reasonable amount of time to ensure that the applicant has completed the application correctly and that they have provided all of the appropriate supporting documentation. That is our role as the bank reviewing the application. We then make recommendation to the SBA for forgiveness, and they actually provide the forgiveness. The timing is 60 days from the date that an applicant provides us a completed application for forgiveness. We have 60 days to submit to the SBA. And true to form, the SBA has 90 days to process the forgiveness and to provide funds back to the customer.
Okay. So until
actually, can I clarify that? They don't provide funds to the customer. They simply forgive the loan balance. Yeah.
Yes. Got it. So how do you guys get paid?
At the inception of the loan, the banks received what was called a lender processing fee, and it varied by the dollar amount of the loan. With larger dollar loans, the fee was 3%, and then it went on an increasing scale up to 5% for small dollar loans. That's essentially our compensation for the program, because as we know, as the program is designed, the intent is for full forgiveness. So we won't even really be earning much interest income.
Yeah.
And even, Julia, even if a bank has to carry a loan, it's relatively short term for a 1% rate. So the income on this loan to banks is definitely in the fee and not in the typical loan interest.
Correct. Thank you, Linda.
So one of the panelists may have had trouble with their own bank. So do we have to go through our own bank to apply, or can we go through you, Julia? You're helping, I guess the question is, I remember when Linda came on 4 months ago, that was a concern because the banks could barely help their own customers, let alone customers that are not potential customers that weren't current clients of the bank. So has that, where are the banks on that? Has that cleared up? And
well, that's a very interesting question. I don't know that we could process the application for forgiveness for a recipient that received it through another financial institution. But I would also say, I don't know why we couldn't. So I'd have to follow back with you on a firm answer on that.
In terms of origination, because I see the question and I think there's one that may still be around originating a loan. There's a handful of banks, including People's Bank, that still originate loans under PPP. You don't have much time left, so you'd want to talk to your lender now. It's always best to talk to your own bank. Some banks have, when I came on and visited with you several months ago, some of the banks were in the mode of just trying to get through their own customers, but the vast majority of those did open up their not all, but the majority of banks opened up to non-customers for at least a period of time. Several banks have reached their capacity in what they can do just from a risk management standpoint. They have, if you're a small bank, you have a certain amount of capital, a certain amount of liquidity, and they're not doing them at all because they've reached their internal capacity. But I would say that the majority that are still doing it, like US Bank, I think has been still taking applications, and they're fairly statewide. And banks like People's Bank are still taking applications. They are taking them for non-customers as well as customers. Having said that, Julia, I think you could clarify for us, would a bank like People's be able to take a non-customer from out of your service area versus someone who lives in Southern Oregon?
As a new applicant for a loan? Yes, we could. We've been very hesitant to do that because banks are still held accountable for a regulation that encompasses what we call know your customer. We still have a requirement that we have done proper due diligence to ensure that the customer is who they represent themselves to be. In fact, I have read that that's been one form of fraud in the program, is people applying that really do not represent legit entities. So it would be on a very case-by-case basis, to be honest with you. For example, let me give an example. We had a good customer here who referred a business that they knew in another area that was not getting the service from their bank that they needed. That was an example of where, because they were referred to us, we were willing to do it. So,
yeah.
So for the question from Ophelia and others around being able to apply, even if you maybe started an application before, you can still go in and apply. If it wasn't funded, you can supplant that original application with another application.
Yeah.
I think I saw a question pop up. Somebody said that they had been declined. I think I might have seen that just pop up real quick, and they wondered if they could reapply. It's only under the most stringent of circumstances that somebody gets declined for a PPP loan. I would encourage that person who asked the question to give me a call.
Yeah, I think they said because they didn't have the right documentation at the time. So maybe they were just missing a form or that kind of thing. So it seems like more of a formality and making sure the banks had the right documentation when they originally applied. But a good question has come up. Someone wants to know, what sort of documentation will you require for forgiveness from independent contractors that have no employees? So it's a little more difficult to demonstrate the payroll. What are you requiring from independent contractors on their forgiveness applications?
I'm going to have to be honest and tell you I need to call that person back. What it's going to essentially be, they had to provide either depending upon how they filed their tax return, in order to get the loan, they had to file a Schedule C for 2019, even if they had not yet filed. So I believe that what they would have to provide is a year-to-date operating statement that shows and proves how they spent the funds.
Okay. So have you, but what happens if the deferment period runs? Can they get forgiveness before the deferment period expires?
Yes, they can get forgiveness all the way up until the final maturity of their note. So there's some people are under the impression that they've got to hurry and get this done before deferment ends, and that is not the case.
Okay, it's just use of the funds that's very regulated as far as the time period.
Yes.
Remember, most banks I've talked to aren't even accepting forgiveness applications yet, because there's a clock that starts ticking for the bank once they get that forgiveness application, and it's not in a borrower's best interest to seek forgiveness too quickly if they may be under that de minimis threshold, especially, if 150,000 or less passes and you can attest in one page to your bank that you spent it appropriately, then it will all be forgiven. Mm-hmm. And that answers the question, by the way, to several of your people on here who've asked about sole proprietors being treated differently and being unable to get full forgiveness. There's nothing that says a sole proprietor can't get full forgiveness. So I'm not sure who's communicating that, as long as it's used for the appropriate costs that are associated with the program, like the payroll cost. So, Julie, I would assume most sole proprietor loans you've done are under 150,000 because of the payroll limitation rules, and B, would be spent primarily on payroll because it's for the individual.
That is true, and that was some guidance that came out very late in the program, unfortunately. And actually, the way the sole proprietor's portion was actually through that Schedule C, net profit prior year. Essentially, divide that by 12 and multiply it by 2.5. And that was what they were eligible for forgiveness. For a sole proprietor, it's almost even more lenient, because as long as they can show that they use the funds to support the business and what they would generally compensate themselves for, then it can be forgiven. And you're exactly right, Linda. The vast majority of those are less than 150,000. And so we're holding hope that that bill will pass and they'll fall under that de minimis.
Very much so. I would say too, just I want to acknowledge that we all recognize that there's some frustration for businesses that applied very early on and were under the impression they had 8 weeks to spend 75% on payroll. And even if they were shuttered, for example, say you're a restaurant and you weren't even allowed to open your doors in the early days of the pandemic, you had to still pay your employees. That's what the program was designed for, was to allow businesses that weren't receiving income to still pay their employees, you know, to avoid them having to go on to unemployment. There's a lot of complicating factors there because unemployment got a boost, and some folks can make more money on unemployment than they could by their boss paying them their normal wages. So restaurants had some confusion there, for example, but ultimately many PPP recipients did what they were expected to do when they got the initial funds in order to obtain payroll, and that was to pay those employees even if their doors were still shut, and to get that money spent in 8 weeks. So it's a little frustrating to a business like that to have to spend all that money in 8 weeks and find out later, when they've already pretty much spent it, that they could actually stretch it over 24 weeks. So we acknowledge that the way this program's been rolled out is super frustrating on a lot of levels. It's extremely frustrating to banks too, to have the rules changing all the time. But I think, speaking for the on behalf of the banking industry, I think the banking industry has done an amazing job getting 62,000 loans out to Oregonians in a matter of weeks, and with rules that were changing every day. And now our job is to help our customers, those 62,000 customers, navigate these very confusing, ever-changing rules around forgiveness, so that you can maximize the forgiveness options under the program, which was always the intent. So again, there's the flexibility is helping a number of customers, especially very small customers or those who got them later. But I do recognize you have some brokerages that may be in the category of businesses that applied early on and you know, have already met the initial criteria. So Julie, I don't know if you agree with that, but
yes, I do. Mm-hmm.
Has there been any discussion or request to allow borrowers to come back for seconds, so to speak, especially for those? I mean, I'm assuming that's not even a potential consideration or an option.
No. Once you've received a PPP loan, then you're good.
Yeah.
If Congress were to reauthorize another program, then that may be allowed. But frankly, I don't see that happening for businesses at large.
Yeah.
We did actually have a couple of occasions where we were able to add to a PPP loan because of a misunderstanding of a calculation or whatever, but it's a little bit of a tricky process, but it can be done. I don't see that though going forward so much.
Any last comments on PPP before we move to the foreclosure moratorium that was recently passed here in Oregon? I
would just invite those attending. I've seen some good questions pop up, and I'm happy for them to reach out to me. I can provide my email address, and they can reach out to me. One question had to do with, does an EIDL loan, EIDL, does an EIDL loan impact PPP forgiveness? That's another one that's been real hard for everyone to get their head around, because that's been a changing playing field as well. The short answer is quite likely it does. Another question, and that's because the EIDL loan and the PPP loan, they're not, you can't get two loans to serve the same purpose. And so what the government is trying to assure or ensure is that they didn't get the benefit of two different types of loan programs to cover the same purposes. So that has to be taken into consideration. Just very quick, I saw a question pop up. If you're receiving unemployment, can you get a PPP loan? The answer is no, you can't. If you are self-employed, you have no employees, you're collecting unemployment, you can't double dip and also get PPP loans, loan funds. So,
Julia, do you know about the taxation of PPP funds for a business?
you mean if it's forgiven, how will that be taxed?
Yeah.
You know, Linda, there was some verbiage in some guidance that spoke to that, but it was not very clear. I know that that is a question on the table right now because some accountants are super nervous about getting forgiveness in 2020 so that the forgiven funds, which are typically taxed, could offset the losses incurred in the year rather than waiting until 2021, for example, when their businesses have recovered, they're in a tax bracket. So I know that that is another item on the table under current discussion.
Thank you.
Okay, since we only have about 20 minutes left, let's get to this beauty of the foreclosure moratorium. Linda, I don't know if you want to, you or Julia, whoever wants to give a little background on the recent legislation. And
Sure.
how do the banks feel about it here in Oregon?
Well, I'll start. Thank you, Julia, or thank you, Jenny. So House Bill 4204, as you all may know, passed during the special session that just occurred in Oregon, and it institutes a foreclosure moratorium through September 30th on both residential and commercial loans. And it prescribes a number of other things in the bill around payment deferrals. It's different for residential and commercial. It has some notice requirements, other issues in the bill that go beyond merely instituting a clean sort of moratorium on proceeding with foreclosures. And these are, of course, COVID-related foreclosures, but that's also very, very confusingly and loosely defined. Even how a person notifies their lender for deferrals is not really clear. So the whole thing, first of all, we believe is a mess. It's one of the most poorly drafted bills we've seen in a long time. And I think that's a product of being written on the fly during a special session without adequate committee hearings for input and for amendment. And I think OAR, as well as any organization out there, knows how important it is to have that dialogue when a new law is going to be put in place to make sure it's workable and clean. Even legislative council didn't have adequate opportunity to improve the language in the bill. So it's a very bizarre process. We did not support the bill. We opposed it actively, and obviously we lost that fight. But we opposed it not so much because we opposed a short-term moratorium on foreclosures, especially in the residential space. But we opposed it because the bill that actually started moving included commercial real estate alongside residential, and they're very, very different animals and different arguments, right? For someone who needs to stay in their home during the pandemic, and for a commercial loan that may be very customized and unrelated in some cases even to the actual pandemic. But also because of all the rest of the garbage in the bill that doesn't prevent the foreclosure. To the outsider looking in, it may look like it helps a borrower by giving them deferral options, but it really doesn't do much in that space that isn't already being done. This crisis, unlike even the financial crisis that we went through, 10, 12 years ago, there has been a lot of tools in the banker's toolbox to provide loan deferrals, loan modifications, waived fees, special loan programs, and banks across the board have been deploying those tools to help their borrowers. We even have seen in the CARES Act that passed Congress all kinds of provisions for deferral and payment forbearance on mortgages that are backed by government-sponsored enterprises like Fannie Mae and Freddie Mac, which is over half of the loans in this state. So, you know, ultimately, borrowers were already getting a great deal of assistance during this time because no bank wants the end result to be foreclosure. They want to try to see their customers through this difficult time. The problem is this bill sweeps in and tries to codify these acts in a way that limits the tools in the banker's toolbox, actually provides less opportunity for banks to do what they do best, which is manage their portfolio and work with their borrowers. So instead, and again, we can take the GSE backed, the government backed mortgages out of the equation because they fall under a very prescribed process in the CARES Act. Everything else that maybe a bank keeps on its own books, portfolios, the banks are in the business of managing their own portfolio, and this bill tries to sweep in and dictate that. But even worse, because it is potentially short term, it's so confusing that it creates all kinds of question marks that no one can answer. So in a nutshell, we don't like it because we think it's poorly written, confusing, goes too far. Ultimately, there's also the question of, will it end September 30th? Because the governor has the opportunity to extend this legislation past September 30th if she notifies us by, or she makes it known that she intends to do so by 30 days in advance of that, so by August 30th. So, you know, the question of extension remains. That could be extremely problematic for the flow of credit in this state if this is extended a day past September 30th. It's already going to have an adverse impact on credit availability just by creating such major problems in the credit ecosystem for the short term.
What about liquidity? I mean, that's a bigger, what about for our members who have buyers who need a loan? I mean, what does it do for the banks and the availability of funds for buyers to get new loans when they can't foreclose on their what's already in their inventory?
Yeah, there's kind of two issues there, Jenny, in terms of the flow of credit, and Julia might have other comments to make. One thing I'll say is it's not across the board for every bank. I'm speaking for the industry as a whole. Mm-hmm. But in some cases, especially on the commercial side, I think you're going to find banks having to be a lot more careful about what credit they extend because there's sort of this unknown period of time in which they're almost unsecured loans. If the collateral isn't really of any value in that you have for an unknown period of time, no ability to exercise that, and there could be a long-term period where no payments are made, then a borrower's or a bank's going to have to be pretty cautious about where it's extending credit. On the liquidity front, really, if there is a lot of borrowers that could pay but don't pay because of this legislation for a period of time, that can create liquidity crunch in the issue in the industry unless cash to lend. There's also impacts on capital and other issues that would be part of that equation. But I think the unknown of a sort of an potentially open-ended policy that says that it's a very low bar to stop making a payment is going to adversely impact credit availability. The other thing I've heard is title companies, and maybe you have some that could weigh in on this that are your members, but I've heard there's some constraints on what title companies are willing to insure during a period of time like this. So I do think it's going to affect credit availability for some of the borrowers that you're representing as realtors.
Yeah. Julia, do you have any follow-up to that? I'm curious, have you seen any changes in underwriting standards yet? since this has gone into effect?
No, it's too new, I think, at this point. I think it could likely impact the residential side even more so than the commercial side. On the commercial side, quite typically, we're dealing with people we know quite well. And there is a faith element, a trust element that they're going to abide by the contract that we enter into. But there still is some exposure, as Linda well described. I think more exposure potentially on the residential side. So we'll have to see how this pans out before we're gonna. But as we all know, the residential market is just really, really strong right now, and so this puts an interesting twist into things.
Which is good news, and I don't know what kind of stats you have, but what current percentage of residential borrowers are not current on their mortgages? Have you had, with respect to this new legislation, the process, you have to notify borrowers, right, that they have this option? I mean, there's certain things that you have to proactively do to let your customers know that this is an option for them, correct?
Yeah, there's an, oh, I'm sorry, Julia, go ahead if you'd rather.
No, Linda, run with it.
Okay. Let me just say that the bill has a notice requirement, which needs to be within 60 days of the bill's passage. So lender has until about the 28th of August to send out a notice to inform borrowers of the law, which potentially expires September 30th. So the notice is a little bit, I don't know, it's we don't necessarily think it's all that helpful. But besides that, you know, I think to your point, a good number of folks have asked for and received payment deferrals on their mortgages. And we've been able to, aside from the CARES Act requirements, make those decisions as bankers too on the loans that are on our portfolio, commercial and residential. And I've seen banks by and large be very generous, but it's also been a conversation with borrowers that's led to, I think, borrowers receiving assistance who truly need assistance. It hasn't been a government mandate. So I think that it's unknown at this point, Jenny, but we are concerned that there could be some strategic decisions to not pay the loan, and that will have long-term consequences for everyone, not only in any kind of future payment that would still be due from the borrower and impact the borrower, but all those things add up to impact how credit flows.
Yeah.
And in a booming real estate market, you do not want credit crunched. We don't have a credit crisis right now, like in the financial crisis. This has not been, pandemic has not led to a credit crisis, but we can certainly create one. And issues like this could end up creating a credit crisis. So we do have concerns. We have steps we're still taking, but there's a whole lot that's unknown about this and how it's going to play out. To us, though, not having it extended is critical for the future free flow of, you know, credit in this state. And I will tell you that there's another issue. Banks, unlike some other lenders, have what we call charter choice. And you can choose to be a state chartered bank. You can be a federally chartered bank. Misconception is that national banks are big banks, but that's not true. For example, Pioneer Trust Bank, Evergreen Federal Bank, First Federal McMinnville, those are 3 banks in Oregon that are headquartered here that are small community banks, which have OCC charters. They're national banks. They might not look much different than People's Bank of Commerce, which has a state charter and is headquartered in Oregon and might be of a comparable size. But merely by having a national charter, national banks have something called federal preemption. And that means that in certain areas of law, they do not have to comply with state law that conflicts with the national rules and regulations under which they operate. So arguably, there are provisions in this bill, especially things that try to dictate terms of lending, that are preempted for national banks. Lot less clear that those would be preempted for a state bank. So a good amount of the residential mortgage lenders that you work with in Oregon are large banks. And there may be provisions of this act that, like the notice requirement even, that they may or may not have to end up complying with. So we're still working through that. So I would caution you to think that every aspect of this bill applies to every lender, because that's not the case. We'll have to see how it plays out. What we can say is only one thing for certain, which is that you probably won't see many foreclosures between now and September 30th. But what I can tell you is that you wouldn't have seen any foreclosures to speak of between now and September 30th if they had never passed this dumb bill. Because nobody's foreclosing that quickly. Yeah.
Well, that too. I did read when I was reading up on this, it's really pleased to see Oregon is first out of the other states that have passed this type of law. It said Oregon also became the first state to create an express cause of action allowing borrowers to enforce the state law. So I'm assuming that means attorney's fees and damages and a variety of other things that certainly could have an impact on.
Right, for certain provisions of the law, that private right of action seems to be available, but even that's not clear. There's also a retroactivity piece that's totally unclear. And when you've talked to 20 lawyers, which I've talked to at least 20 lawyers about this bill, and they have 20 different opinions, you know it's pretty confusing. I mean, maybe they always have 20 different opinions, but in this case, there really are probably 20 different interpretations of certain areas of this bill.
It seems like that's the case for a variety of pieces of legislation that came out of the special session. But it depends.
For sure, Jenny.
Yeah. So given that, do you anticipate that perhaps there might be some litigation on this mandatory forbearance?
There certainly might be. Yeah.
Oh, good. More excitement and fun. Well, I hope it doesn't get extended, but I thought that was the whole idea of passing something in the special session to avoid an additional mandate from the governor to extend the moratoriums.
Well, she doesn't necessarily want to have this in her purview anymore. So she wanted the legislature to take it up. She was thinking about instituting an executive order at one point that would do similar things and ask the legislature to take it up instead. So I don't know that her inclination is to get involved with any kind of extension, but we do have some worries about the rapidly increasing rate of COVID cases and the pressure that she'll be under. So if the OAR is equally concerned or concerned about this legislation and an extension, I would hope you would support us and weigh in with the governor that this is not helpful. There's a lot of things that you could argue from a realtor standpoint. I mean, this bill, for example, didn't carve out any like abandoned or properties. So, you know, there's a lot of concern about inventory too, just that could sit there, that could be moved. A lot of concerns about credit availability for future home buyers, that kind of thing. So we'll probably, Jenny, be talking to you shortly about our efforts in avoiding an extension, and maybe there's a place for OAR to participate on that.
I'm sure our lobbyists and GA team would be more than happy to visit with the bankers about this. Is there a potential for an amendment in the special session?
I think, you know, you mentioned legal action. Amendments is the second channel. A third channel is, of course, working on advocacy with the governor on the extension. We don't feel really optimistic about that channel of an amendment. As you know, the next special session is going to be fiscally focused, and there's going to be very limited consideration of policy. And I don't know that the speaker, who this was her baby in a lot of ways, is interested in going in and changing it, even though I think the Department of Financial Regulation and all kinds of others in the state are realizing that it's deeply flawed. and would probably like to see it cleaned up. I don't know if there's going to be a willingness to do that for what is a short-term bill.
Yeah, well, it looks like the long session next year may be longer than you all had hoped for. So let's get, since we're almost out of time here, how about if we get to a few questions if we can. Are non-Fannie Freddie lenders exempt from the forbearance extension?
Non-Fannie Freddie lenders exempt from the forbearance extension. Well, the CARES Act deals with government. I think I'm getting the question. I'm slow, but the CARES Act had provisions in it about forbearance specifically for government-backed mortgage loans. So that would be Fannie Mae, Freddie Mac, etc. It did not prescribe a forbearance requirement for non-government-backed loans. So, for example, if People's Bank of Commerce makes a loan that it keeps on its books, as an example, CARES Act forbearance didn't tackle that. This bill at the state level does encompass the loans that banks make themselves, but it doesn't prescribe forbearance using a term that has a specific meaning, but is sometimes used more broadly. It prescribes a payment deferral, which is a type of forbearance, but it's a payment deferral that is allowed for qualified borrowers. So yeah, that the state law doesn't apply only to GSE.
Yeah,
but
gotcha. Yeah,
so,
makes sense. So before we run out of time, someone asked, when's the drop dead date for your forgiveness application?
Julia.
Because the sunset date is August, I think August the 3rd, that means that authorization from SBA has to be received by August the 3rd. And so we build in about 3 or 4 business days prior to that to allow us time to receive the application and process. So our drop dead date is July 31st.
But what about for forgiveness?
Yeah.
Oh, is there a drop dead date for forgiveness? My understanding is that you need to apply for forgiveness prior to the maturity of your loan. So there's a little bit of confusion there too. The original loans were done with a 2-year maturity, and then loans done, I believe after June the 5th, were mandated to have a 5-year maturity. So those that got them later have up to 5 years to request forgiveness. Those that got them sooner in the program have up to 2 years. However, they can contact their lender and ask the lender to consider converting their 2-year maturity to a 5-year maturity.
And that's at the bank's discretion.
It is, but I can't imagine a bank wouldn't comply. Number one. Number two, I don't anticipate anybody's going to wait even 2 years to request forgiveness.
Yeah.
Julia speaks for her bank, but I will say that I do think, I just want to be honest, there are plenty of banks who don't like that idea of a 5-year term on a 1% loan that could be forgiven much more immediately, because that's a lot of effort for a bank to carry loans like that on its books for 5 years. So there's a number of banks that probably wouldn't be too keen on the 5-year conversion, and because I already know that that's the reason that they stopped making PPP loans. And I didn't mention that earlier, but another reason a few banks have gotten out of making new PPP loans is the term of 5 years. So Julia's bank is so community minded, so open minded, that I appreciate they've stayed the course through it all.
They're very nice down in Rogue Valley. Very nice.
Good fresh air when it's not, when there's no fires.
True, true. Do you have any closing comments for our members that might be helpful before we say goodbye to everyone today? Anything they should think about regarding PPP or foreclosure moratorium or anything else banking related that will help them continue to propel forward and keep our market moving and strong?
No, my only words would be the intent of the PPP proceeds was to inject those funds into the market, to spend the funds, help keep our economy alive and well. And so I would encourage people to do that. That was the intent of the funds. But I would also encourage, don't be panic stricken about this forgiveness aspect. The program was designed with forgiveness in mind. And I feel quite confident that if folks applied in good faith for the loans and they have used the funds as it was stipulated to be used, I just feel very confident they will not run into problems with forgiveness. And I want to assure people to not be too nervous about that.
Very good.
And I agree with Julia, and keep your eye out for the federal legislation that could institute the simplified presumed forgiveness for loans under 150,000. And then my parting remark is thank all of you for A, listening to us, but B, for what you do. I think together we're going to be able to help this state with the economic recovery that we need to have once this pandemic passes. And it's going to take all of us working together to make sure Oregon retains not only a robust credit environment, but a robust business environment too for jobs and future economic success. So thanks for what you do as part of that important part of that equation.
That's better. Those are very good closing comments. And thank you so much, Linda and Julia, for being with us today. And Linda, I know you are so busy, and I appreciate your willingness every time I reach out to you to help and assist our members with updated information. So thank you to the bankers. And Julia, enjoy the nice weather down there in Medford. It's pretty nice up here today too. So
do anything for you, Jenny. You have a good one in Jenny Pacula.
Oh, Linda, you can send me the bill later. Thank you.
Thank you all.
Thank you, everyone. Have a good day.
And for all the attendees, the video will be in YouTube starting tomorrow without CE. And if you'd like to view it for CE, if you know anyone who would like to view it for CE credit, we will be sending out that link in our monthly newsletter. It will be available on our website around July 24th. Thank you.
Thank you, Erica. All right. Take care, everyone.